like what was the catalyst was Russia coming out and basically pre-approving a vaccine. And so that was an excuse for a number of holders of gold to sell their gold. My presumption is they bought in at 300 or 700, wanted to lock in some of the gains ahead of what that vaccine might do. So that was the spark. But the fundamentals here are still really strong for gold for the long term. And I point out an immediate reason and a long-term reason. The immediate reason is even with a vaccine, we don't have a flu vaccine just because flus are very complicated. And any development of vaccine, there's a big question as to how effective it's going to be, what type of population is it going to have the best impact on, all those things, right? And so there's a lot of unknowns there. And then the second thing is when you take a look at the long term, I was mint director from 2006 to 2011. And during that time was the last financial crisis and then the highest gold prices ever until right now. And what happened then was, even though gold ran up at the very beginning of the financial crisis, it didn't peak till 3 years later. And the reason why was there was uncertainty as to how the economy would recover. And with all the fiscal and monetary stimulus, there was a question as to whether or not that would cause inflation if the economy caught on too fast. And it wasn't until those two things became more certain that gold started to go down. We're at just the beginning stages of this crisis, and so there's plenty of room for gold to go up. A number of things are affecting the U.S. economy right now. Obviously, the pandemic, which affects the whole world, but also the politics of what's going on in our country. We have a presidential election coming up, and we have two candidates that have diametrically opposed approaches to fixing the economy, right? And so that's a lot of uncertainty. If it goes one way or another, it's going to have a big impact. And then the last thing, which for me as an American is very troubling, is all the social unrest that we have here. And so the United States has traditionally been known as this island of stability through crises. And because of this social unrest, you've seen the dollar degrade or fall to its biggest drop in over a decade. And I think that's going to continue until we're able to work out some of these social issues. In short, there's many ways to invest in gold, and there's a certain type of investor of which holding an ETF really works well for them, particularly institutions who don't want to worry about storage of that gold or the managing of that gold. And so, yes, you're going to see more institutions start to raise their positions in ETFs over time. Already, you're seeing greater inflows into those ETFs, of gold and of capital. And so, I think that is one trend to watch in the future. Mining stocks, more recently, like the last 10 years or so, have always lagged behind gold prices. And there are several reasons for that. One is that it's unknown as how much gold they can mine, and so there's some uncertainty there. Whereas when you invest in an ETF or buy gold, you know exactly what you're getting. And you have to depend on management, good management at those. So that's another layer of uncertainty or risk. But also, over time, what we figured out is, there's a limited amount of gold in the earth, and you can't recreate it in the lab. And to our knowledge, all the major deposits of gold have been discovered. And so where most of our gold comes from today, from these mines, are basically remining that gold dust from all the debris. And so that's placer gold, very hard. You have to, on average, crush a ton of rock in order to get enough gold dust to make 1 gram of gold. And so you add that up to what it takes to mine an ounce of gold, and you see the prices of all in mining to be $1,100, $1,200 an ounce. And so when gold was around that price, it wasn't worth it for these mines to mine that gold. But now I think you're going to see redoubled efforts on the mining companies because there's some profit for them to be made. And you're going to see those stocks eventually rise if gold demand remains strong. When you take a look at the historical trend among central banks with gold, net, they have increased the amount of gold on reserves, right? Virtually every country, China leading the way. Whatever they, they started 7-8 years ago with maybe 1,000 tons reported, and they've doubled that. So they've steadily been buying up gold. But as you said, many of these countries, are under the economic crisis of the pandemic, and as a result, they're hard pressed. So I do think that you're going to see some of these central banks sell some of their gold in order to take advantage of that cash to pay for social programs and economic stimulus. But by and large, central banks' holdings are relatively small. And so, I don't think you're going to see a lot of activity there. But from time to time, you do see a net decrease in some central banks. I think you're going to see that right now. Between China and India, that's over half of all global consumption. And as you know, in addition to investment purposes, safe haven, or hedging against inflation, a lot of Indian and Chinese buyers buy it because of a cultural preference to buy it, right? They want to own physical gold for portability in case something happens. They want to show it off as a way for them to say, we've made it from lower class to middle class, and we have excess, income, so we can afford to buy gold. So there's a lot of those reasons. And when you look at a lot of that gold that's being bought, it is not in the form that investors usually buy in, which is government-made bullion coins or large bars. It is mostly jewelry for exactly the purposes that you and I have just discussed. And so I do think you're going to see some pressure for people to get more liquidity by selling their jewelry. But by and large, I think the biggest impact on gold prices is because of the economic crises globally, the middle class has less disposable income, and so they're buying a lot less jewelry. I mean, when you take a look at the numbers, the jewelry purchases in both India and China, that's what's really fallen. It's not that people are selling because they want to keep what they have. It's just that they don't have enough money to buy new stuff. Question on a lot of people's minds, Biman. So the way I approach it is I have the benefit, and the scars to prove it, of experience being around as mint director during the last financial crisis. And when Lehman Brothers and Bear Stearns went out of business, people were panicking. They were jumping into gold, and then Bush had his stimulus, Obama passed his stimulus. That still wasn't doing it. The Federal Reserve started quantitative easing, and gold really jumped. It jumped from like $750 to like $1,100 from the beginning, before the crisis happened to when the crisis was happening. But then gold marched up to $1,928 over the course of 3 years, right? And that was because it took that long for us to take a look and say, is the economy recovering? Yes, it's a mediocre recovery, but and it looks like it's going to be a predictable mediocre recovery. And once you have predictability, you eliminate uncertainty, and then investors start to relax, right? They're not panicking anymore, and then that's when they start selling. So from the peak that came when the crisis started happening, gold continued to march to a historic record high of over $1,900, and it took it 3 years to go. I think we're at the very beginning of this economic crisis. I think we have not figured out how the global economy is going to recover. I think we've printed a lot of money from the Federal Reserve, and there's a worry that unlike the financial crisis, the pandemic was basically turning everything off. And so there is a fear that when you turn everything on, the things that can be turned on, they're going to race towards some type of normalcy, which could create inflation. And so with those two factors, I think gold prices will continue to rise until it becomes clear how the global economy is going to recover. And in its recovery, will it recover without inflation? When you can answer those two questions, gold will stop rising. A lot of the metals that are commonly looked at as precious metal, gold would be primary, silver would be another one, palladium and platinum. And of that, the ones that have greatest access to investors are gold and silver. To buy and sell and exchange palladium and platinum is a relatively small market compared to gold and silver. So when you segment gold and silver out, silver prices in many ways reacts the same way gold prices do. And that's why it's usually called the poor man's gold, is that the same dynamics, right? A safe haven for you to pull money out of stocks and bank accounts and hold it in a bank, as well as a hedge against inflation, because silver prices and gold prices have an inverse correlation to the value of the dollar. So when the dollar goes up, gold goes down, and vice versa, which is another reason why you're seeing gold prices go up. So saying that, silver is going up. Now, the other part that influences silver that makes it different than gold, silver is cheaper, right? So silver, $20 an ounce versus $2,000 an ounce for gold. That makes it more accessible to retail investors. So a person walking down the street will have a hard time buying this, which is a 1 ounce gold coin. So you and I don't have $2,100 in our pocket to buy this. But for a silver coin, most of us have $20 in our pocket to buy a silver coin. And so silver is much more accessible. And then second, silver is more volatile. And so with silver prices that go, right now they're about $20 an ounce. At its historic, during the financial crisis, the last time around, it reached $45. Its world record is like $48. So there's plenty of room for silver to go up. But one of the reasons why it's more volatile is silver is more used by the rest of the economy, whether it's in electronics or in jewelry, etc. There's large industrial use for silver, and that demand for it. So if the economy is going well and people are buying a lot of silver and they're worried about inflation, there's a lot of pressure to push up silver prices like the last decade. So a lot of people now, because gold had broken the $2,000 mark, they're beginning to take a look at silver, and I think there's plenty of room for silver to grow. I can really respond with more expertise on the U.S. market. So I don't know all that's happening globally, but I do know that in the United States, there are certain situations where, because of the slowing down of the economy, currency is not circulating as it should, right? If a business is closed, that money stays in the cash register. They're not giving it out to customers. They're not returning it to the bank at night as a deposit. And so as a result, there are some municipalities of which there's a shortage of physical currency, and they're beginning to go to Depression era solutions, like printing up their own tokens to be used as money, right? And so you hear stories about that. But what's also really interesting is, since the last financial crisis, 14 states out of 50 states in the United States are pursuing Article 1, Section 10 of the US Constitution, which allows them to give their citizens the ability to settle their debts in gold and silver. So how do you do that? And there are enterprising companies that have come up with things like this, which are really interesting. This is a gold note. And Utah has said that this can be used as legal tender in that state. So what this is, it is 1/10 of a gram of gold, just smaller than a grain of sand. It's about $6 worth of gold. And it's sandwiched between two pieces of very durable polymer. So now, instead of a coin that might be worth $2,000, you can buy gasoline, you can buy your groceries using these notes. And Utah and Texas and Colorado and Wyoming and a number of those states are pursuing how to operationalize that part of the Constitution.